Hi, Dominique, and welcome to another week of Key Events Ahead. And as we always seem to say, it was certainly an exciting week um, in the markets around inflation growth, but particularly this seemed to be the week that people started pushing back on this. We're already in a recession, and maybe the Fed pivot is way too early, if at all. So yeah, what was your kind of big takeaways, I guess, over certainly maybe start with the data and how the markets reacted. And then we can talk about any Fed speeches or Fed speakers.
So I've been very consistent, as you know, Andrew. I've said if you looked at the data in detail, it was very clear that the economy was not headed to recession. I was expecting a positive surprise on the NFP, certainly not a positive surprise of this size, because it suggests that growth could be accelerating when my view was that growth was slowing towards potential, so towards 2% from currently about 4%. And that it would go to that level of 2%. But 500,000 NFP, wow, I think this suggests growth could be accelerating from where we are now. And frankly, it wouldn't be inconsistent with a very loose policy setting that the Fed has. Hey, we have almost double-digit inflation, and the Fed funds is what? Between 225 and 250, which is negative 7%. That's ridiculous. How can monetary policy be slowing growth when we have a deeply negative Fed funds rate? This makes no sense. You don't need a PhD in economics or a triple PhD from MIT, from that matter, to figure this one out. And maybe that's why we got these strong comments from Bowman. So Bowman is a governor. She's a member of the board of governors in DC. She represents community banks. So she's not an academic, highly credentialed academic economist with a fancy schmalzy titles and a very big CV. But she has common sense. She talks to community bankers, meaning
she's who probably know what the real economy. They'll know what Main Street. Yeah,
totally. And she said on Saturday that the Fed should consider going 75 basis point a meeting until inflation shows a sign of slowing down. And the voice of reason is finally speaking within the FOMC. What can I say? I'm speechless. How can they expect to slow growth when the policy rate is negative 7%? And to make matter worse, the curve is inverting. So mortgage rates fell again this week. Financial conditions are easing.
So what can they do about that? Because let's say they signal to get to what we were talking before, 4% by the end of the year. If the curve inverts by 130 basis points, say 2s, 10s, like, what are their policy? Is that hampering them to have a real effect on the economy, or is that the economy just saying, okay, fine, we understand, or the market saying we understand, this will really hit growth, and that we will enter a recession and things should be fine. Yeah, so like, how can they handle the fact that the curve keeps inverting?
They have to convince markets that they are going to be a lot nastier than what the market expects. And let me explain why. It's because, why do we have, inversion when the policy rate is so low? Usually when we have inversion, it's when the policy rate is much higher. It's for a host of reasons, which I shall write about in due course, of course. But it's also because markets are looking through the current policy tightening and recession and thinking that the Fed at the first sign of negative growth, will reverse course and cut.
Yeah.
So I think that's really what this inversion reflects. And so for the inversion not to happen, the Fed needs to tell markets, sorry, guys, we are focused on inflation, not on growth. So until we see inflation come down in a convincing way, we will keep hiking, even if unemployment is rising. And that, for a central banker, is a very difficult thing to do. And in fact, the Fed has a much tougher job in that respect from Volcker, because we are in the same, we are in the same situation as with the second oil shock in the late 70s. Unemployment, well, actually, unemployment has not even started to go up. But, in the late 70s.
At the same time, unemployment's at like 50-year lows.
No, but this is going to make it even harder and even more painful for the Fed to stabilize the economy. This will not end well. I can very well see a crisis of governance at the Fed.
Yeah.
But to come back to so what they have to do and why it's tough. I mean, so Volcker himself, before he pulled the trigger in early 80s, actually eased policy in 1919 in March, because he saw unemployment going up and he didn't have the stomach to hike when unemployment was going up. So inflation accelerated further, and then he saw he had no choice. But he didn't have to tell people, this is going to hurt you really badly. He just tightened and then let things unfold. But now, with this crazy policy framework that we have and with forward guidance, when the Fed does that, it has to tell people, this is going to hurt really badly. And if it doesn't do that, if it shows, I think eventually they will show the 8% Fed funds rate in the SCP. But if they show it with unemployment, say at 4% from currently 3.5%, no one will believe them. They will have no credibility, and the curve will invert further. So the Fed needs to convince markets that even if we have, unemployment 6-7% and rising, they will keep hiking until inflation comes down.
Okay, I understand. So it really comes down to, this is not going to be all sorted in 6 to 8 months. Even, by the way, if it kind of looks like it's sorted, they're not going to believe, and probably for good reason, that it is properly sorted. Inflation has to come down, the economy has to slow, and for a meaningful period of time. So there isn't, there's not going to be a quick fix and everything's fine.
Which is what the market is expecting. And the more I think about it, and the more I realize how far we are in terms of Fed messaging from where we need to be, which makes me wonder, and actually more than that, ponder maybe about a governance crisis, that maybe we need another team at the Fed in order to change that narrative from, soft landing, no problem, our best case scenario, to, sorry, guys, but the previous management really messed up things, and now we have to apply the brakes, and it's going to hurt really badly.
Yeah. Which I'm sure, by the way, Larry Summers, he loves, delivering a bad message, let alone trying to avoid it.
I won't speculate on who's
Larry Summers giving his empathetic, we know that people are hurting.
Well, personality-wise, it would be a good fit. I'll stop at that.
So, but I just have one question before we move on. But why is 10 to 30-year yields coming down so much? This is not like a short-term thing. This isn't like they're going to hike, and then cut. I mean, are you surprised? Is it also just because there's still just so much liquidity in the system?
So there is that, that basically the Fed has been practicing financial repression on a scale not seen since the 1950s, even though, which is extraordinary. The Fed is independent, but it acts as if it was completely under the thumb of the Treasury.
Right. To be fair, this coincided the same time of all of Europe having deeply negative rates, including at times 10-year, but I mean, my feeling, it wasn't just them. This has been like a coordinated mess up across central bank policy globally.
Totally. Totally. So groupthink is killing us within
Yes.
central banks and across central banks. They have these meetings at the BIS completely under the radar, where they chat. I mean, the Fed, being the biggest, baddest guy in the room, sets the tone. You have the BIS staff who does outstanding research and warns the Fed before the GFC that, things were going to get bad. Also trying to inject some common sense of the discussion, but being completely ignored. So in that sense, we have a bit of a repeat of history. But yeah, I mean, central bankers groupthink is going to kill us.
Yeah. And your just general view, and it's kind of like more of a Bilal strategy, but like, which part of the curve is definitely too low to you? The most too low? Is it 10-year yields, or is it, just focus on like 2-year, and that's really where you think you're going to get, like, we could get to, let's say 7% at 2-year, and 10-year could still be at 3.5 or something. So that's a massive inversion, but yeah.
Totally. I think we are going towards massive inversion. And again, I'll be writing about why. I think, it's easy. It's probably a better bet to short the 2-year bond, because it's more predictable what's going to have to happen there. While the long end of the curve is going to be tricky. Maybe I mean, certainly at the moment, the deep inversion is my base case scenario. But if we are to, tackle this inflation, slow growth, the 10-year for the real economy is a benchmark yield. So it has to rise. And it's going to be, how markets work. It's not like we get 3 months advance notice of a big change in regime. It's more like we wake up one morning and things have moved. And so I think, the deep inversion is still my base case scenario, and probably for a long time until the Fed changes its messaging.
Is there anything they can do to, would they be okay with a deep inversion, or they're like, well, we're raising rates, but the problem is housing is a big part of it. And if mortgages aren't going, like 30-year mortgages aren't going up because 30-year treasuries aren't going, is there stuff they could do? Can they like significantly accelerate quantitative tightening, or there's just not that much they can do outside of talking about it?
So they could try to sell bonds, but the problem is they would make deep capital losses, because when you think about it, QE followed by QT is basically a buy high, sell low investment strategy. And the problem is this Fed is not thinking enough in macroeconomic terms. They are, worried about the politics, and basically, if they sold their securities, they would wipe out their equity. They'd probably want to go to Congress for a recap, because unlike an EM central bank, they probably wouldn't be happy to operate with negative equity. And this is going to be a can of worm. So, and even if they sold the bond, in a way, the Fed is in the same position as an EM central bank that intervenes in FX market. They are one of many players in the market. So if they have an intervention that's consistent with market expectations, they'll claim it works. But, given that they are only one of many players, if their view is completely against the grain, I mean, look at what's going on right now. They are letting the bonds run off, but the 10-year is not going anywhere. They're not going to be able to influence the market, especially since they lost a lot of credibility. So, which brings me back to my bottom line: they need to regain their inflation fighting credibility, and that's going to be painful.
Right.
which, by the way, was a little bit the situation in the second oil shock. No one believed the Fed would have the guts to tighten when unemployment was going up. And here, unemployment is not even going up, but as you said earlier, people think, oh, this is just a 6 months story, and then we'll go back to cutting. And I think it's very, very mistaken.
Yep. Okay. Okay, cool. So, and then on the week ahead, between data, speeches, is there, obviously we know, like, for a lot of Northern Hemisphere, obviously this is kind of part of the summer, but is there particularly stuff people should look out for? And what's your view on those things?
So my favorite, the CPI. I'm joking. Well, it is super important, but basically for the CPI, for sure we will have an improvement in a headline. But I think even the current Fed is going to look through that, and they will look at core, obviously. And there, I'm okay with a consensus view because, to be honest, it's such a volatile. The month-on-month number is so volatile. It's really hard to have strong conviction on 10 basis points above or below consensus.
Right.
What is more interesting for investors, I think, is really three things. One, the Cleveland Fed trend mean and median price CPI, which has been a much better predictor of trends since the pandemic than core CPI.
I know
so
yours,
we need to look at. And then I will be looking for continued acceleration.
And sorry, and what are you calling for that? Or what is the market calling for that?
It's not, and again, it's such a, so there is no, it's not in the Bloomberg list to be predicted, and it's so technical. It's really, again, it's really hard to offer a forecast of value, but it's basically the trend is going up, and one or maybe both of these measures should go up. Should reflect it.
Okay.
And then so services inflation, the really bad thing in Friday's NFP was a jump in wage growth, which suggests that we are moving on to a new path of acceleration for wages and for services inflation. And what is extraordinary is that we had this jump from 30 basis points to 50 basis points, even though low paid employment is recovering. So it's going faster than higher paid forms of employment. So instead,
but that makes sense. I would have thought that salaries are jumping more on the low end.
Well, yes, but that should pull down the average, right? And the average is what we get. And the average jumped despite what you're saying. The average
it's even more surprising. Okay.
Yeah, and so we saw what was happening with the private sector employment cost index accelerating above 5%. I mean, we could be by the end of the quarter, we could have an ECI on 7% year-on-year handle, and it's a disaster for the Fed because, and that's the other thing to look for. Right now, we have a slowing goods price inflation, which reflects that supply chains are improving. But what I will be looking for is less of a decline in goods price inflation because the war in Ukraine is not getting any better. The sanctions are not going to be eased. Then we have all the issues in China. China is going through a lot of internal strife. And then you have their zero COVID policy. So those things at some point, and then we still have to find out what will be the Chinese reaction to Nancy Pelosi's trip to Taiwan. So there is still a lot of risk attached to those global supply chain, and at some point, we're going to see those risks materialize with a stabilization of goods price inflation at some positive number. By comparison with before the pandemic, where we had actually goods price deflation. So we could afford to have services inflation above 2% because it was offset by goods price inflation. But now we have positive goods price inflation. So we need services inflation to go back to below 2% from currently 6 or 7%. So we're talking about, I mean,
massive. Yeah.
It's massive. And it's not a 6-month story.
Yeah.
Really not.
Yeah, I think the market, I agree. And then are there any Fed speakers that are anticipate to speak this coming week?
I think we have 4. To me, what will be important in those speeches, whether they hint at regime change, in the sense that they were thinking, remember, since the beginning of the year, they've been telling us an inflation slowdown is around the corner. Oh, we will wait to see if inflation slows down, and then we will act. And now we are getting hints that growth is not slowing, it's accelerating. Wage inflation is accelerating. So we're moving away into that scenario where things were slowing. And by the way, that was my expectation, that things would slow, but not slow enough for inflation to go down to 2% without a recession and Fed tightening. And the Fed was saying, no, things will slow down enough. This is what I called immaculate disinflation. We won't have to hike that much. But it looks like both the Fed and I were wrong, that things are not slowing, but could be accelerating. So I will be, and this is what the message from the speech, from Bowman's speech on Saturday, that's the key message. So I will look for hints that basically the Fed is panicking in those speeches. They won't, of course, they will never, openly panic, but hints that maybe things are not slowing. Maybe we need to do something.
And we need, we're doing this to help to be clear with American public and Okay, cool. Anything else?
No, I mean, in terms of politics, we have the stories that doesn't want to die, which is the Build Back Better. I think now it's called the Lowering Inflation Act. I'm not sure, but it's amazing how these things, it's like a blob, really. You try to push it down and then it blobs back and it bubbles, but there is something there that we should pay attention to, because basically the game in Congress is let's try to not add to the deficit without raising taxes, which is kind of a difficult exercise if you want to raise expenditure. So Congress has been reaching in all kinds of places to generate those revenues, and one of the things they are looking back is a tax on buybacks. And buybacks have been a big support to the equity markets for God knows, since for the past 20 years. So let's watch this. 1%, I think they're talking about 1%. But it's not much. But if this is one of these, tax sources of tax revenue that no one is really fighting a lot about, or that people ignore, it could get bigger and it could start having market consequences. So nothing to worry about in the short run, but definitely something we want to keep on our radar screen.
Okay, awesome. All right, thank you, Dominique, and appreciate everyone who's listening to this, from our clients, investors. As always, please reach out with any kind of questions, feedback, etc. And hope everyone's enjoying this, and obviously enjoying this great insights from Dominique.